Hit it.
It's August 7, 2020, episode 91. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, Patrick interviews Larry Berman from ETF Capital, where they talk technical analysis, behavioral finance, and his outlook on the markets. Then it's time for fan favorite Kuppy's Corner, where we learn how Harris went from the Street.com teenage trading wonder kid to the best crypto fraud, bull market riding hedge fund manager out there.
And then this episode is still a part of our summer special where it is interviews only. But next week, we'll be back to our normal format with This Week in Trading History, WTF clip, and the top 3 things to watch. But for now, let's just get to the first interview. It's my pleasure to have Larry Berman, the host of BNN's Bloomberg's BermansCall and co-founder, partner, and CIO of ETF Capital Management, co-founder of Quintessence Wealth, joining me. Welcome to the show, Larry.
Well, thanks, Patrick. It's a pleasure to be here.
Now, Larry, I always like to have our listeners get to know the guest a little bit with more detail of how you got in the business. So why don't you give us a quick history of where you grew up, where you went to school, and how you got started in the business?
Well, I would say, where I live now, outside of the couple years that I worked in the States, I've probably lived within about 5 miles of Yonge and Steeles. So, high school, I went to Newton Brook, right behind Center Point Mall. It's called Center Point now. It's Town and Country. And I grew up in the Bathurst and Steeles Jewish community in the Bathurst and Steeles area, and went to York University. So it was, and for most of my adult life, I've lived in Thornhill. So it's been very, very close. Despite my extensive travel across the country and around the world at one point. But, how did I find investing? A couple of things. My father worked for in a warehouse, and the company he worked for was listed on the Toronto Stock Exchange. And I think when I was probably 8, 9, 10, 11, I started, I would read the sports pages in the Toronto Star, and then I'd get into the business section, and I would follow the company, Westburn Industries, and I would watch it, up a half and down a quarter, and I just got very interested in it then. But it was really when I was in university, I was going through school to be an accountant, and I was sitting in an advanced auditing class or intermediate auditing class one night, and realizing that I couldn't possibly do this for the rest of my life. But that was in 1987 actually, and literally getting home, that night, the stock market crashed, and that really piqued my, I was interested before. I actually had a part-time job while I was going to school as an assistant to a financial advisor, and while I was going to school, I was selling mutual fund units of what were the original RESPs, registered educational savings plans, and we were selling units of trust. And I thought, well, wouldn't it be great if I had this instead of going into all this student debt, going to school. So that really got me interested, and then I got my first job coming out of school as working for a financial planning firm, and I was going to go back and do my master's degree. Had fully intended to do that, and but I couldn't really afford it, and so I got an opportunity to stay on and become a financial advisor, and that's kind of the path I went down.
Right. And now I had the privilege of getting exposed to your work close to 20 years ago when you were the chief technical strategist and managing director at CIBC World Markets, where you were ranked as one of Canada's top analysts. Now, I worked at CIBC at the time, and I regularly jumped onto your weekly conference calls. In many ways, you actually paved the way of my interest in technical analysis. So how did you get into CIBC? How long did you stay there? And then what ultimately made you make the jump to starting your own firm?
Well, yeah, I wanted Wall Street. And when I first got involved with the Canadian Society of Technical Analysts, it was my second job in the industry at Burns Fry. And there I met Keith Edwards, who was the technical analyst And Keith was not great on computers, but he was okay. And I helped getting him set up on the downloader and using Metastock. And, every night we go download the data. And so I became kind of his sort of protege, I guess, and he introduced me to the CSTA, and through the CSTA I found the Market Technicians Association, which is now the CMT Association, which I've been intimately involved with for years. But I wanted Wall Street, and around the same time, just getting married and starting a family, I said to my wife, I want New York, and the MTA was offering an internship program for people who were very early in their career but wanted exposure to technical analysis, and so one thing led to another. I got very fortunate, but I won the internship in the summer of 1994, and I got to spend the summer down in New York. And part of the internship, there was about 10 different placements, 2 days with this guy, 5 days with this guy, and so forth. And, I got down to the floor of the New York Stock Exchange. I went to work with a market maker on NASDAQ. I got to spend 2 weeks with Alan Shaw in the very famous and now defunct Smith Barney, technical analysis room. And so that was really for me the start of my career, and I had been exposed to technical analysis. But ultimately coming back from the States after almost 2 years in Boston was when I landed the job at CIBC. And my wife just she didn't adapt well to the move to the States, and she wanted to come home. And it took me quite a while to find a job, but the firm I was working for in Boston allowed me to work 1 day a week out of Toronto, and I was looking for a job, and it was very coincidental. I happened to be on the CIBC Wood Gundy, back then it was called, trading floor, the institutional business, seeing a client, and we were doing real-time technical research on the fixed income markets, Eurodollars, BAs, and I called in to get my voice messages, and I actually got a referral from an advisor at CIBC because they were looking for a technical analyst to work on their bond desk. And I'd been doing fixed income research in Boston. And so I get my voicemail and I'm looking for a job, and guy says, "I'm Peter Martin. I head the research and strategy group here at CIBC, and we're looking for a technical analyst to work on the bond desk here." And I'm like, I was literally sitting on the bond desk when I picked up my voicemail, which was very funny. So I called Peter back right away and said, out of sheer coincidence, I happened to be on the CIBC trading floor. I said, "Where's your office?" So I'm in the far corner. So he comes out of his office and he waves, and I'm in the middle of the trading floor and I wave, and we hit it off. And a week later, I had the offer to come back to Toronto. So it worked very well. And I was at CIBC for almost 10 years.
Right. And so what made you make the jump to starting your own firm then?
It was always a dream of mine to want to hang a shingle. And I have got an entrepreneurial spirit in me, and I without speaking badly of anyone in particular, I had a lot of experiences at the bank, and I found that a lot of times there was this unwritten conflict of interest behind, in making investment decisions and doing what's right for the ultimate client. And I kind of said, one day I've just got to do it better. I've got to really kind of do it better. And the interesting thing was, so in the middle of that, I come back to Canada in 1997. And I've got a couple good years under my belt as an experienced technical analyst, and building a bit of a name. And so in 1998, the Canadian Securities Institute was looking for someone to create a book on technical analysis as part of a course. And somehow I don't remember how I came by them, but I was introduced to someone there, and we kind of hit it off and said, would you put this book together for us? And that's kind of how I kind of got into that. And then BNN came along. And that was in 1999. And there was one of the anchors, Lou Skeezes. So Lou had been calling around because they were doing this market call show, right? It's their flagship show every day at noon, and they have one in the evenings now. And they were looking for people to come on who were analysts or portfolio managers or advisors and take phone calls. And I had a bunch of media experience from my time in the States, and I had been doing a morning hit on Canada AM for CIBC as one of their strategists for a while. And so they saw me on there. And anyways, I have lunch with Lou, and he says, you want to come on? So the first week Market Call was on the air, I was on the Wednesday show. And so right from literally day 3 of the beginning of that. And after a couple of years, the head of the station called me up, and he basically said, Larry, when you're on our show, people really like the way you merge the fundamentals and the technicals, and you put everything together. And so your ratings are the highest of anybody that comes on Market Call. And I go, wow, that's pretty awesome. And so they offered me my own TV show. And CIBC at the time said, no, we don't want you to do that and give it away for free. And, there was that element, but, go on Market Call and whatever. And so I kept doing that. But ultimately, when the opportunity came to start my own thing, I don't want to talk exactly how things came to an end with CIBC, because it isn't a wonderful story, but at the end of the day, things worked out very well. And then BNN said, well, do you want to do a full, come on every day, you'll have your own show? And I said, well, I'm going to be a portfolio manager. I'm going to start an investment management business, something I always wanted to do, but I won't have time to do it every day, but maybe one day a week. And so BermansCall was born shortly after I left CIBC in 2006 to launch ETF Capital Management, and that was it. The idea was really to be independent from the banks and to offer something that and focus on education. That's really the two reasons we did it.
Yeah. Let's talk a little technical analysis then, because I know that you are very much involved in the technical analysis community, whether in Canada or in the US or internationally. And you certainly have written a textbook in Canada on at the Canadian Securities Institute for technical analysis. So why don't you give all our listeners a quick rundown of your involvement in all the different associations?
Wow. So, my first job selling mutual funds, not when I was selling the RESPs, but the one I had taken after finishing university. So one of the advisors there used to be a floor trader in Chicago, and he got me, he brought out a copy of, I think every technical analyst that was been in the business 30, 40 years, and some of my mentors that I met in New York in my internship tell you the story about before computers, how everything was done on paper. And so he brings out the Mansfield books, those are the old point and figure charts and looking at the long-term history. And so he's thumbing through it and showing me all the charts, and I'm being very visual. I'm just sucking it all in. And that was my first exposure to charts. And Bob said something very memorable to me. And he says, kid, it doesn't matter what they write on the piece of paper. It matters what they do with their money. And he was talking about, sentiment, and he was talking about behavior. And that was my first thing. And at the same time, I was doing the Canadian Securities course and taking that education that you would take, because I did not go to do my MBA. I chose that. And so what I found was you could do a CFP and the CIM, and back then it was called the FCSI, I think, Fellow of the Canadian Securities Institute, and then there was the CFA. So then I started doing all these things kind of on my own, and somewhere around 1991, I think, I had just written the CFA Level 1, and Keith Edwards at Burns Fry at that point had said, why we need someone to join the CSTA board. Basically, we need someone to write the newsletter. Why don't you do that? And I said, sure, absolutely. Let's. I'm in. And that's where I found the MTA and found out about the CMT program, and then really more formalized my technical education at that point, because up to that point it was, I had some Metastock and I had the charting package and we downloaded data, but there was no formal training other than reading, a couple of books. The first book I ever read was Winning on Wall Street by Marty Zweig. For don't fight the Fed. That was the message. I fight the Fed every day these days.
Welcome to the club. No. So now you were president of the Market Technicians Association for a while, right?
Well, I became the president of the Canadian Society of Technical Analysts when I came back from Boston. And that was sort of 98, 99, 2000 timeframe. And I was asked, as Canada hosted the International Federation of Technical Analysts conference in 1999, and as president, I actually chaired the committee to put the event together. We did it at Niagara on the Lake, at the White Oaks Inn, and so we hosted everybody from around the world at the ZIFTA conference, which was great. And so as the chairman of the conference, I got to a spot on the IFTA board. And then a couple years later, the MTA had asked me if I would join their board. And so I did, and ultimately became president after a number of years, a number of positions on the MTA board. So, very, very intimately and actively involved with the professional, network of education and technical analysis. And I'll tell you, the friends and the networking that I've benefited from has been just tremendous in my career. Without the MTA, I have no idea where I'd be right now, if I'd even be in this industry, frankly.
Yeah, for sure. And now when I was getting my CMT designation, and I'm very grateful, Larry, that you sponsored me, which now in hindsight I look at was like a trial by fire, I guess. But anyway, there are so many different forms of technical analysis, and you learn so much throughout the programs, and you can make technical analysis as complex, doing everything from Elliott wave to GAN and all these different things, to just keeping it really simple. Like using a moving average technique. Now, like over your 30 plus years in this business, how would you characterize now your common approach towards technical analysis?
Well, it's night and day, because when you're an analyst, and the idea of the original idea of the CMT exams was training analyst, technical analyst, not a portfolio manager, not a day trader, not an analyst, someone who writes research reports. And there was actually a huge battle between the original group of guys in New York that got together, Ralph Acampora, John Brooks, handful of others, in New York in the 1970s, and created this institution. And when it started to get beyond a handful of guys in New York who looked at charts, and it became more professional, and it started going around the world, and realizing that a technical analyst wasn't just a guy writing a research report. It was a trader on a desk, and it was a sales trader, and it was a portfolio manager, and financial advisors, and so it broadened out, tremendously. over the years. So the history is fantastic, but the difference for me, what I learned as an analyst, I had this great conversation with one of my friends and mentors over the years, Ralph Acampora. I first met Ralph in '94 when I was doing the MTA internship, and Ralph used to be an elf on Wall Street Week, and I used to watch Wall Street Week with Lou Rukeyser back in the 1980s, and
Wow.
and I remember Ralph coming on, and he was very, very bullish on that Friday show, and Monday the stock market crashed in '87. Right? so I was ribbing him about that when I got to meet him, and I also said, Ralph, I created this technical system that I used to trade, and it was written up in the Financial Post by Patrick Bloomfield. One of the things the CSTA did in the early 90s was they had this Lunch and Learn series. And Patrick, who was a journalist for the National Post, would come out to the lunch, and whoever was teaching or lecturing that day would say, "Here's what I do," and this. So I created this thing I named after my son called the Brandon Line. And it was basically a mishmash of stochastics and RSI, the basic indicators that we would all kind of look at, and I was trading S&P 100 OEX options on it. And I had some success and some failures and everything, but the idea was just to kind of share. So 1994 comes, and I remember Ralph had said on Lou's show that he was bearish or bullish, whatever it was the opposite of my position. And I thought, well, he knows this is Ralph Acampora, he's an elf on Wall Street Week. And so I told him the story. I said, Ralph, you had come on a couple years ago and you were bearish or bullish, and it was against my position. So that Monday I exited. And I said, you know what? You were wrong. and he literally smacked me on the side of the head very lightly. And he said, what are you, stupid? I wasn't talking to you. I have no idea what your trade was, or I was just, being me on TV. And, right. And I started thinking about this. And then years after, when I started ETF Capital Management, I had talked to Ralph, and Ralph had left the sell side and gone to work for his cousin on a firm out of Switzerland doing investment side, actually managing money. And we were going through the great financial crisis. And I said, what we learn in the charts and fiduciary obligation and portfolio, this is night and day different. Right? How you used to trade for your own P&L, or, in a prop book for a bank, is very different than having a fiduciary obligation and running a mutual fund. Right? It was night and day different. And so, you can talk very simple in RSI and this and that, and then you can talk about being a portfolio manager and taking the skill and the craft of technical analysis and applying it to your fiduciary obligations. And it was a night and day difference thing for me for running portfolios to being an analyst. Because when you were an analyst and you made a wrong call, you change your price target, no big deal, and people forget it a week later. But when you've got an ongoing P&L called a mutual fund that people have put their life savings into it, what do you do when you're wrong, right? How do you mitigate? And so it's very, very different.
It is.
Yeah.
Yeah, it is. So let me ask the question this way: if right now one of our listeners came to visit you at the office and asked you to pull up a chart on a stock they wanted you to look at, what would your chart look like? What indicators would you have? Would you be using candles, line charts? So how are your charts set up? What's your approach to looking at a stock and you?
Well, I have my Bloomberg terminal right in front of me here, and my big main chart center screen is, the candlestick chart. So I get a better sense of the behavior and the reversals and the areas of support. And you can see a little bit clearer on a candlestick chart than you can on a bar chart, and certainly very different than a line chart. I've got an RSI, overbought, oversold type indicator with some modifications that I've put on it. And I've got a relative strength line. I've got relative strength to the target I'm trying to beat. So, if I'm benchmarked to the S&P 500 and I want to add something to my portfolio, is this a good time to add it in the relative strength line? Does it make sense? Right? From is it outperforming, underperforming? Is there a catalyst, and so forth? So yeah, relative strength is critical. It's about alpha, outperformance.
For sure. So, often in technical analysis gets a bad rap in this industry, but that has been changing over the last decade. And now, how do you commonly pitch the merit of utilizing technical analysis to those kind of portfolio managers or other high-end investors that don't yet utilize it?
Well, so I guess I have the benefit of being a CFA as well. So, I would say to someone in a very, very nice way, I know what you know fundamentally, but I know all this other stuff too. The CFA answers the what to buy decision. The CMT answers the when to buy it.
Oh my God, that's the way I approach macro. It's funny that you say exactly. I say it tells you the what and the why, but it doesn't tell you the when and where is it going to go. And technical analysis bridges that gap. I love the way you put that. That's a great way of explaining that. Now, what I wanted to ask you then further to that, like technical analysis has evolved or changed since or do you think that technical analysis evolved or changed since the rise of social media and the personal devices like iPhone? It appears that there's like no shortage of junior technical analysts flooding the internet with like a trend line break or a resistance line test. I mean, do you think that this is a change for the better? How do you think this has impacted the market?
Well, at the end of the day, however you drive your investment decision, whether it's fundamental, technical, how many people are looking at it, it's still the price is the price is the price, the behaviors. But compared to, when I started almost 35 years ago, computers were just becoming a factor if you could afford it, but there weren't charting packages like that. Yeah. That even didn't exist. And you only have to go back 5 or 10 years before that where, listen, you don't have a choice. Everything was done by hand. So the charts where the 200-day average was in the areas of support and resistance, they weren't available to everybody, and now they are. So the idea of a self-fulfilling prophecy of the 200-day average being an area where people might transact a little bit more than they would at any other price might be more today than it was, the day before or 30 or 40 years ago. But the behavior is still the behavior. So it's the human nature that we observe in chart patterns that is not changing. It might be a little bit faster than it was before. It might be a little bit easier. But like a CFA or anything other kind of formal education, there are people who use it well and there are people who don't use it well. I always speak out critically of Elliott Wave, for example. I was on a bull-bear debate with Bob Prechter years ago. And in fact, after that, Bob asked me to be on a movie he made about Elliott Wave, speaking out against on the negative, on all, why I thought it was a little bit bunk. And so not every technique works good, and it's really the practitioner, and, it's kind of like a golf swing, like what suits your eye, So, I always tell people, I said, and for me, I go to a lot of seminars and I listen to what other people and how they use things. But ultimately you take and you use fundamentals, technicals, the tools that kind of fit your style. And it's really important you don't try to be someone else, and you try to incorporate things on your own. So a lot of things are very esoteric, and I it doesn't work for me.
So now, Larry, though, you're talking about a very individual technical analyst for an individual that's investing for themselves. But there's been huge growth in assets under management for a lot of these CTA trend following systems that are, just trading billions and billions of dollars. And obviously the markets are driven by liquidity. And so when some of these CTA trend following systems are getting signals to change trend, they contribute to creating volatility. What's your opinion on that? Am I off base on that? Like, what's your interpretation of how that has evolved?
It's Tom DeMark created a massive number of indicators over the years, and at one point was very exclusive to a few different hedge funds, Paul Tudor Jones and some others, and so through my years at the CSTA, we'd host the annual conference, and I would be involved in that. We'd always bring up some keynote speakers. Anyways, years and years ago, I met Tom DeMark, and he said something at a conference, and I'm not sure it was CSTA or MTA conference years ago, but he says, I want to know not what happens when it hits the 200-day. I want to know what happens in general when it fails to do what you think it's going to do. And it's those kind of behavioral things that I think are really learning. Learning how to apply the craft, because there are lots of the access to charting tools are, as you've pointed out, are like never before. Anybody, yes. Online accounts, everybody's got access to them, but it's how you incorporate them into I think what your style is that's important.
All right, let's talk some behavioral finance, because I know you're still involved with the Market Technicians Association, where you're like a subject matter expert on behavioral finance. Well, let's first start off by just letting our listeners that don't understand behavioral finance, like, what is it and why is it important in your mind?
Well, the it's the decision making. It's what we learned from Kahneman and Tversky in their seminal work, going back to prospect theory. And it's the understanding that what drives our decision making as a human tends to be very driven by hormones, frankly. And we think we're being thoughtful and cognitive. We observe the 200-day, and we know that there's an expectation that might be support, but if it breaks, it might turn into resistance, and that's what we learn in the books. But it's the behavioral around the decision making that's so critical, and this whole area of behavioral finance that's been incorporated for many, many people into the investment decision process started from Kahneman and Tversky's work by understanding that people dislike losing money far more than they enjoy making it. And so there's a skew to the bid and ask. And we see it in option pricing. We see that in premiums paid for puts over calls, and it moves during market swings, and behavioral is an important learning, and it's not just sentiment. It's understanding what's driving the decision making process, and so I'm a subject matter expert, and I write many of the exam questions for the CMT exams in the field of behavioral finance. And trying to educate our people who are becoming CMTs on how best to incorporate the thought process behind the investment decision making as it relates to behavioral finance.
Well, it's so true, because so many theories involve rational investors and self-control and things like that. But the investors in making decisions are not rational, and they're not influenced by their own they are often influenced by their own biases or cognitive errors occurring. And it's so important, because we commonly do so many of these in human nature. It's just something that that we as investors do all the time, and recognizing that helps us better understand the way the price is moving and how that plays out. And a perfect thing to talk about there is, let's just talk markets, because particularly this year, 2020. So much psychology involved with this COVID and this price movement and what's going on. We have, this government-induced recession that, rightfully so, was prioritizing public health over that of the economy. And while at least now the economy doesn't appear to be showing signs of a V recovery, we certainly don't see a V recovery in corporate earnings. But there's a lot of technicians, and price being that are showing the V recovery in the stock markets. And so we have the stock market doing one thing, and obviously the economy and investors and unemployment and everything doing something else. How do you interpret what just happened this year in 2020? Isn't this crazy?
Well, it is, and things move very, very fast. When we talk about bear markets and the average length and duration of bear markets and sizes, in recessions, the average bear market is 29%. If you measure by the S&P 500 standards, going back to World War II, if you measure them all, and so this move down, if you want to call a move down that takes, like, it's never been faster, including 1929, for us to fall 35% over a couple of weeks. So, and then to snap back as we've done, but the amount of government support and liquidity provided is just off the charts, stunning when compared to anything else that's ever happened. And don't fight the Fed. However, I for the better part of the last decade, I've been talking about on my show on BNN and in public presentations, the quality of the economy today compared to a real strong economy. So I go back to the 1990s and I say, well, that was the last big expansion before a recession. Now this one that we just had, now we're in a recession now, but this one was the longest. And I said, well, what was the 1990s? I said, well, you had falling inflation from the high inflation of the 70s. So that was a tailwind. You had the peace dividend. The Berlin Wall came down. You had so many fundamental positives. And the most of all was the birth of the internet. And that fundamentally was growth. That was GDP of 4, 5, 6%, real for years.
Right.
And then you had the bubble that ultimately came with the internet, the breaking of the bubble, and then you had this liquidity-driven rally that Greenspan started, I guess, when he first put interest rates to zero to fight the dot-com, and that created the housing bubble. And then in the last decade of money printing, QE, unprecedented, all the central banks in the world, and zero and negative interest rates. And then you look at the quality of this and you say, the amount of debt in the world has almost tripled in the last 12 years. And going forward, it's only going to get worse. And I say from a fundamental quality perspective, the economy today is a house of cards relative to the 1990s. And I think it's only a matter of time before it breaks. But I've been saying it for years, and yet
join the club.
they keep throwing money at it, and it recovers. And you're getting these V-like recoveries because of the liquidity. But it's not quality. And so the markets fundamentally are getting more and more expensive with all the financial engineering. I mean, it's insane. Like Patrick, tell me it's not insane that the Fed went out and bought Microsoft, Apple, Amazon, Berkshire Hathaway corporate debt. Like they need the help, right?
Yeah, it's insane. I mean, They're literally just trying to flood more and more liquidity into the system. It's not even about helping the companies out. It's about the fact that liquidity, it's crazy. That's
well, the fact that the system doesn't work and it's fragile when you go through these economic shocks tell you that there's a massive problem. And I think, off the record, and if you were to ask Jay Powell or Ben Bernanke, I don't know, maybe not, maybe they're too academic and they don't get it, but some of them that were market people, with Jay Powell was a market person, off the record, unofficially, how bad is it? So I had this conversation, and I asked him to come on my show, and he wouldn't do that. He's now a very senior officer at one of the largest asset managers in the world, that at one point in his career ran a central bank.
Right.
Okay, so again, if you can figure it out, it is great. So I'm having this conversation, and I said, were it not for all the money printing and liquidity, what would the world have looked like through the great financial crisis if they hadn't done all that? And he said it would be worse than the 1930s, because the financial world is so integrated today that we don't have a choice. And so they've got to keep doing this and doing this and doing this. The system is too big to fail. And so we're in this zero rate. So now gold is finally starting to reflect that, right?
Yeah.
So there are some asset classes that will benefit. And I turned really bullish on gold a couple of years ago with this in mind, and it's playing out, quite well here.
For sure. So listen, you prepared a few charts. Let's just quickly go through them. I know they have a little bit to do with the sentiment and the cycles. And so what are you trying to suggest with this first one here?
Well, so prospect theory. So Daniel Kahneman, Amos Tversky. This chart changed my life, because when I was in 2002, I was reading a book written by Nassim Taleb called Fooled by Randomness. He wrote his Black Swan book like a year or two after that. And this is one of his first books. And it reintroduced me to the idea of prospect theory, which I had come across actually in my university studies, because my one of my economics professor was a fan of Kahneman and Tversky, and in 79 they came out with this paper. So in 2002 they were awarded the Nobel Prize in economics for this, and it got me really thinking about this cycle of market emotions. And so what we know mathematically, if you measure point in time returns from low points, so you go back in history and you go all the low points, what is my forward 5 and 10 year return? They're fantastic. But if you, again, with the benefit of hindsight, if you take all those forward returns from a high point out 3 years, 5 years, 10 years, they're terrible. And so what does that tell you? It tells you got to buy low and you got to sell high. The difficulty is that bottoms are relatively easy with the panic that comes into charts and the big spikes in volume. Tops are impossible to time with any certainty, but we understand there's a certain environment at a top. We're much closer to a top today than a bottom, given the froth, given the high PE, but this liquidity could push it another 6 months, 12, who knows? But maybe, just maybe, the U.S. election and the U.S. not ready for a push towards socialism is going to matter. But we won't know that until we see it with the benefit of hindsight. And that's the challenge, with putting in, with being an analyst versus being a portfolio manager.
Right. And on your next slide, you wanted to touch on risk-adjusted returns.
Well, so this is what I talk about sleep at night portfolios and what we try to do for clients. And so another Nobel Prize winner, two of them, Harry Markowitz and William Sharpe, got together and they created this thing, the Efficient Frontier, portfolio optimization. And it's all about understanding, if I'm going to add something to my portfolio today, what is that expected return going to be compared to doing something that has no risk? So we call that a treasury bond typically, divided by the cost of holding that position, defined by the volatility or the standard deviation of that holding. So that's what the Sharpe ratio is. It's the expected return of what you're going to own minus the risk-free rate, because there's no standard deviation in something risk-free like a GIC or a guaranteed government bond, generally speaking, guaranteed as they can be these days. and divided by that risk factor. So everything I'm going to add to my portfolio at any point in time, we do this analysis. And it's done with a combination of fundamentals and technicals. And so if I'm going to add the S&P 500 today, Patrick, for the next 3 months, 6 months, 12 months, whatever horizon is, what is that expected return going to be compared to adding the Russell 2000 or the European benchmark or some other sector? And so ETFs today, the whole world's made up. There isn't anything you can't put in an ETF today that represents an asset class. So this is what we're doing. Now, the challenge with this, of course, is that the traditional way of protecting and the risk-free rate it now has a real yield of negative, right? After inflation and tax, even after inflation, there's no real return left in fixed income. So this whole model of safe portfolios is out the window probably forever until things can normalize. And I don't see that until there's a reset. And I don't see that for decades. And I think the next iteration is they're just going to print money and get rid of all the debt or most of it.
I love the fact that you brought this up, because I was going to go here with a question, and I think it's a great opportunity for us to discuss it, because over with the modern portfolio theory and the creation of this efficient frontier and everything, then what's worked over the last 3-4 decades has been that traditional 60-40 portfolio. And that and even risk parity funds today rely very much on that inverse relationship, where a 10-year treasury yield behaves almost like a put option or insurance on portfolio, reducing volatility of your entire balance. But we're now approaching that zero bound on yields, where how much more can a treasury bond contribute to reducing volatility and or contributing to even returns? And so, what's the future hold for us? How does one approach portfolio management in this new era in these next decade to come?
Well, for my clients, option prices, options, because you can put on a put spread and protect, let's call it 10% downside risk for some horizon if you feel there's an event coming. Now that that costs money. So you can pay for it there's option strategies that you can incorporate into a portfolio that there's no cost to, right? So you can sell a call and buy a put and put a collar on it, and for very low cost, you can have sort of a natural hedge. So what that allows you to do is create a whole portfolio full of equities, but dampen the volatility with a derivative, as opposed to the traditional way of looking at bonds. Because bonds, from a yield perspective, for sure don't give you the same protection. You still, if you have enough duration in your bond portfolio, can get that inverse correlation, assuming all these risk parity funds don't get unlevered during a bad crisis like we saw in March, where gold, everything got plowed for a week. The same thing happened in 2008 and 9, by the way. Bond correlations go to 1, nothing works, but put works, right? Being long volatility is going to always work for you to mitigate risk in a portfolio. The only question is, how much is that going to cost, and how do you do it?
Implementation is everything, but what you're saying, it speaks to me. I'm a huge options fan, and that's exactly the way I'm looking at it. So at this final chart you prepared for us, what are the probabilities? What are you looking at here?
So this goes back to World War II, and it looks at all the recessions. So all the shadows at the bottom, those are the recessions over history. And so what we look at is we measure the recession and the market impact. And so this answer helps us answer the question, when should we buy? And again, if you measure all the recessions, the average correction is 29% post-World War II. If it's a mild recession, 24%, severe recession 34. Those are just averages. So coincidentally enough, if you look at the drawdown in the S&P 500 here at the top, we can see that this peak to trough decline is a little over 35%. And so that, from a risk reward, never mind where support is or anything else, just from a pure probability standpoint, you should have been putting some money to work at that point, because history tells us that that kind of drawdown is attractive. And that goes back to the Sharpe ratio, right? So when is the risk reward attractive looking forward? Well, in the last 4 months since that low, we've had a 45, 47, something like that % rally off the low. Yeah. That's an extra 4.5%, 5% over 10 years that we got in 4 months. But you always have to be buying dips. And a study like this just gives us a little bit of a roadmap on when to do it. But not every deep correction is a result of a recession. Like if you look at the 1950s, and you look at that correction in the early part of the 1950s. So what's that? Well, you've got the Korean War going on, and but why are those corrections really small? Well, because when you go back and look, the starting point, the PE, the valuation, when the recession started, wasn't really high. Right. Unlike today, where the PE on a trailing or forward basis is 3 standard deviations, higher than normal. So when you get the recession, you get a deeper correction. You get a earnings contraction, and you get a multiple contraction. And then you've got a correction in the early 1960s, and you can see that was the first one that was around 30 since the post-war period. There was no recession there. So what caused that? Well, that was the Cuban Missile Crisis. So sometimes it's geopolitical that causes these big things. And anyway, so when you go back in history, you learn a lot. And I equate them to the probabilities. And I love this chart because it grounds me and it gives me some insight into when I should be buying. But absence of any recession, the average correction for U.S. large caps, 13.5%. Right. And if you're not buying that, if you're stopping out down 15%, you're a statistical fool. Right. If there's no recession coming, you got to buy that. Now, you don't know if that dip is going to be 10%, 15 or 20, or you don't know. That you don't know, you can't know. You have an idea where that 200-day average is. You have an idea where that Fibonacci is. You have an idea where that old low is, but you don't know where it's going to stop. But statistically, if you're not buying on average and starting to get overweight or back to your benchmark or whatever at 13.5, if a recession isn't evident, then you're an idiot statistically.
Right? Well, I'll tell you, like what was really crazy for me during this crash that happened, I was fortunate enough actually to be short, and I actually covered my short pretty good right near the bottom end of it, but I couldn't bring myself around to buying the dip. And it was the biggest, obviously a big mistake, because I simply looked at this and saying, how is there not going to be this ugly recession? Bear markets typically take 6 months to 12 months to play out. How do you start buying 1 month into this kind of a drop? It was such a difficult, and the rally was so like the reflexivity of the rally was so rapid the other way. It's like you literally had a small window to act, right? How, do you just systematically deal with it? Like, how did you approach it?
So this is the difference between being a trader, an analyst, and a portfolio manager. So, what's your benchmark? What's your goal? And so once you're down 34%, you got to be at least back at your benchmark, right? That's a no-brainer.
You're waiting.
You just have to. So for us at that point, we lifted all our hedges. Right? Not all of it. We because fundamentally my valuation target was about 1,800. So I thought 2,200 was the low. I thought 1,800 we could get there, and we should see more fallout here. The unprecedented liquidity caused this snapback far more than it probably should have. But I still think we are in the hope rally. and the economic fallout still to play out, because I don't believe, and I get the special nature of COVID. This is not a Fed-induced recession like all the other ones have been, where they're tightening. This is a special thing. This is not geopolitical. This is a special thing. There's more to come here. I don't think it's over. I can't tell you when.
Yeah,
right. I don't know when,
but it's a $64,000 question, right?
It always is. But based on my cycle of market emotions and what I'm observing, this is not the time to make a big bet. You have to be somewhat underweight here. And how much of that is really
underweight to the upside? You mean
underweight to the upside? It could still keep going, because the advanced decline line peaked in the middle of 1998 and it kept going up for 2 more years, right? So we never know with precision until hindsight confirms. But what I can tell you statistically is this is not the time to make a big bet, but it doesn't mean it can't keep going higher.
So, Larry, I'm going to fire off a bunch of questions because we're going to eventually run out of time here, and there's so many things I want to pick your brain on. So let's play some rapid fire questions and test you on the stuff. Now, let's start off with that U.S. dollar. Now, you're into behavioral finance and psychology and all these different things. I mean, what's your take? I mean, is this we're oversold? But it seems consensus that the dollar is going lower. It's consensus that we're about to see the U.S. dollar potentially lose its reserve status, and all of these things. The sentiment is very much. Is this overdue now for a little bit of a retracement from this incredibly oversold?
Yeah. I think the people who are talking about that don't understand how the world works in terms of money. I think as long as I'm alive, the U.S. dollar will be the reserve currency status. Read what Ray Dalio has written about, because if you're selling dollars, where is that money going to go, right? So the only other large blocks of currency are the euro, possibly the Japanese yen, although probably not, and the Chinese yuan. Those are the only blocks of currency large enough to have reserve currency status. And it can't be the Canadian dollar. Our economy's not big enough. We can't put out enough dollars into the system. So that is a factor. Now, is China going to become the reserve currency of the world in my lifetime? And I don't believe it will, but I do believe that China will make a play to be the reserve currency of that block of the world. And with their Silk Road Initiative, they're trying to facilitate trade with the localized economies there and Europe. And if the U.S. doesn't play this smart, that is a risk. But today, are you happy doing terms of trade in Chinese currency? And most of the free world, the answer is no. So until the Chinese economy fully opens up, I don't think they'll be able to compete with the U.S. dollar for that. But is Taiwan going to do that? Is Thailand? Is Vietnam? In that part of the world, it's more acceptable to trade in Chinese currency than it would be in the rest of the developed world, I would think.
What about just taking something like the Dixie chart and looking at just how oversold we are? I mean, we saw like a 10% drop in the dollar just over the last, many months. I mean, is this something that you think is a sustained trend?
The euro came to be around 116. We're not 1% from that today, roundly speaking. So to say the dollar's cheap or expensive, and the Dixie is mostly euro. So I think that's a false argument, certainly relative to the last few months. But if you look at the since inception chart of the dollar index versus and primarily the euro, bad argument. If you go back before the euro and you talk about the Plaza Accord in 1985 and what that meant for global currencies, that was the US dollar being extremely overvalued, and there was an agreement to weaken the value of the dollar. We're not there today at all. And I would argue strongly. But what I can tell you is the dollar is devaluing, or sorry, gold is appreciating against all currencies these days.
Yeah.
And that is a more important story, I think, today, just underscoring the fact I'm not a gold bug whatsoever. Because
that trend is evident, though.
But that trend is evident, and gold's breaking out in just about every currency you want to look at.
So now, to me, gold hitting this around 2,000 number on the upside, you're seeing basically an environment where things like the gold miners bullish percentage index and other things are at extreme levels, having tapped into 100 numerous times. There seems so much froth on there. Do you think this is a period where gold and gold miners are a little bit overbought and due for a breather?
Well, sure. From a short term trading perspective, absolutely. But if you look at gold miners, so relative to the 2011 high in gold, still like what 40% ish below those highs. 35?
Oh, there's plenty of room to go. There's no doubt about that.
You're not going to see the sector peak, I think, until gold stocks get expensive relative to gold. And so I think there's a tremendous upside potential here. You can see those spike highs in 2010 and 11 up above the 60s. And so that's another $20 plus from here on a $42 ETF. So
and such an extended bottoming formation on these monthly charts. Like there's plenty of room for bull market to go, even if there is a pause on the interim, right?
It is. I mean, you got to factor that it was at $30 before the risk parity funds delevered and gold got pounded and got these stocks got cut in half for a week. Gold bullion didn't get cut in half, but the gold stocks, because they're used as a proxy in these risk parity funds. And I bought into it because, that was a forest through the trees thing. You understand that this trend has potentially years to run, and don't let the volatility or the noise shake you out from what is a very, very rational, solid, fundamental story. And fundamentals, at the end of the day, I love charts, but fundamentals are fundamentals. And there's potentially years to go here. It's really, you've got this disinflationary and deflationary cycle we're going through now as output gaps are massive all over the world. And that's going to lead to perhaps a decade of stagflation as the world tries to recover from this, and globalization shrinks and costs go up. And so gold looks great in almost any scenario because they can never balance a budget again. And austerity just not going to work in the world as it's been laid out today. And the monetary regimes are changing towards MMT, and that's just so bullish for gold.
All right. Well, listen, as Canadians, we can't not have a conversation this long without touching on oil and gas a little bit. I mean, certainly we had some pretty extreme prices earlier in the year with negative oil futures and energy stocks just getting hammered. But even just over the last while, oil has been holding up, but a lot of the energy stocks have been fib retracing those little rallies they had off of their March lows. What's your take on the energy markets in general?
I think they're tradable. I don't think energy is investable as an asset class going forward. I think the world is really serious about climate change, and it's kind of like the Fed raising interest rates. So this last time they were only able to raise interest rates a couple hundred basis points before they had to ease again. And that's kind of how I see. So we're going to have these trading rallies in the energy space, and natural gas is better than crude oil. But they're all going to be lower highs, and the best is behind us. I think within a decade, 80% of cars are going to be on battery driven. We've hit peak demand for crude oil. I know the narrative. I get it completely, but I'm very much a believer in the future is not measured in 10 or 20 years. I'm talking about the next hundreds and hundreds of years. There's no alternative but for renewables. And when I'm doing some renos to my house, and my contractors, because he knows I'm thinking about putting some solar panels on the roof. But in our climate, it's not ideal, right? It's not the best risk return. And as the technology improves, that gets better. But wind is interesting. And I go, well, who the hell wants a big wind turbine? He says, they got these little mini ones now that you can barely see the way you put it on your house. And it can literally power, a house like 300-400 megawatts a month.
Wow.
So I would probably need 3 or 4 on my house, but it's all year round, and it's silent. You don't even hear the thing, and that technology didn't exist. So technology is going to solve a lot of the challenges that the green world has. I'm wildly bullish about that. So I think we're past the best before date for the energy sector, but it doesn't mean you're not going to have explosive trading rallies from time to time. And who would have thought negative prices on oil futures?
Well, that was insane. That was insane. So listen, I got to leave you with one more question, and then we'll start wrapping things up. We can't not talk about the elections coming up, right? And with Biden, at least on the polls, is positioned to potentially win the next presidential election. So in your mind, do you think are the markets already baking this into the cake? And as well, what are the market risks going into the election from a portfolio perspective? And more importantly, what do you think that a Biden presidency would mean for the markets?
Well, I'm a policy guy. I've always, from a macro perspective, what governments do drive their economy ultimately. And so policy is important. And what Trump would do for the next 4 years compared to what Biden would do are very, very different in many regards. And we're not ready for, like, he would completely reverse Trump's corporate tax cuts. First of all, those tax cuts were ill-timed and ill-advised. 8 years into a market expansion, you don't cut taxes for corporations. Like, it was just bad policy. Now you should cut taxes for corporations, right? Now when they need it, right? So you save that for a rainy day, but Trump was about Trump, and it wasn't about smart policy. It was about politics. And so I hate the politics of politics, but policy is really important for me. And we're not priced for the antitrust that especially if we get a sweep and the Senate goes Democratic, which I think it has a very reasonable probability on doing that. And the market's not ready for that. But historically, when you go back and look, the market doesn't start to have any anxiety till after Labor Day. Up till that point, there's summer vacations, people just don't care, and then up until the middle of August, you got earnings. And so we're going through that earnings now, but once we get through Labor Day, we might have an aha moment, and it might be 10, 15, 20%. It might be less than that. It's hard to say, depending on what the starting point is. But it's about the swing states, right? The red states over time stay red, and the blue states stay blue, and through migration and different changes, they move over time. But there's about a dozen states, the swing states, and Trump is behind, not by insurmountable amounts, but the reason Trump went for coal, steel, and aluminum was because he had to win Pennsylvania. And boom, that's simple. He had to win Pennsylvania, or mathematically, he was not going to be able to win the Electoral College. And so he won Pennsylvania, Michigan, and Wisconsin by under 78,000 votes combined, and each individually less than 1%. And he's statistically behind, but not within the error term, plus or minus 4 or 5%. So it's possible. But I asked the question very simply. He said he was going to bring back the jobs. And how many new coal, steel, and aluminum jobs are there in Pennsylvania? And the answer is there's less jobs today than when he took over as president. So I would say failure, and I would say that marginal person that just couldn't vote for Hillary, that maybe plugged their nose and picked Trump, is not going to do that again, because he didn't do what he said he was going to do, and they've seen him as a person, as a leader, and frankly, I think he's a narcissistic sociopath, and it makes me sick. Now, politically, I fall on the center right. Okay.
Yeah.
I'm not sure if I was American, I would be voting for him as a Republican president. I would almost certainly vote for my senator and congressperson on the Republican ticket. But I don't think I could vote for him. I don't think, but when Hillary was ahead last time, I said, listen, the average person hasn't had a raise. And Trump is if he's anything, he's a brilliant marketer, and he understands how to manipulate people. And MAGA, Make America Great Again, brilliant, absolutely brilliant.
Yeah.
But he didn't do it. So I don't think he's going to win. And the market doesn't believe that at the moment. They think he's going to win.
But do you think that if the Democrats sweep, that this is a drag on the stock market performance on U.S. equity moving forward?
Well, so there was Goldman Sachs put out a paper a couple of weeks back, and they did an earnings analysis, and they said Biden's policies enacted in 2021 would be worth about $20 in earnings for the S&P. So whatever they're expected to be next year under a Biden win, take off $20, and now you've got a more expensive market. So something will, and that's
a drag.
It'll be a drag. That's probably worth 3 or 4 multiple points on the S&P. And if let's call it 150 for earnings, just to make the math easy, 450 to 600 points off the S&P, 15 to 20%. So that's kind of what I'm looking for at some point before the election as a gut check. And then we'll see what happens, on the election month. And I'm not calling it the election night, calling it the election month, because there's going to be legal battles. There's going to be difficulty counting all the mail-in ballots and so forth. So that uncertainty too is a challenge, unless it's clear by a wide margin that Biden's won, or Trump has won by a wide margin. But Trump's not going down easy.
That's for sure. That's for sure. Well, listen, Larry, it's been so awesome having you on the show. I've really enjoyed it. We've gone overtime. But it's been a great chat. But before I let you go, can you just please take a moment and tell all of our listeners about your business and where our listeners can find you and follow your work?
Well, we founded ETF Capital Management in 2006 to create custom ETF portfolios for clients. So our minimum investment typically is $1 million and up. And as you know, with my show on BNN, I focus a lot on education. So we have an extensive outreach in social media. We have a new YouTube channel. We're putting out a lot of content at LarryBermanOfficial. Go have a look at that. Follow us on that, or subscribe, as they say there. Follow me on Larry Berman ETF. And, I talk a little politics. I'll talk a global macro, and we always comment on what's moving in markets. And if you're interested in the funds we run and the ETF we run for Bank of Montreal, the Z Sleep at Night portfolios. Come check us out. And thanks again, Patrick. It's been a great chat, and look forward to seeing you at some point when we can be less distant.
Absolutely. We'll go for a beer. Anyway,
all right.
Larry, thank you so much for joining us, and we're going to get back to the rest of the show. Thanks.
Well, folks, it's that time of month again. It's time for Harris to join us in Kuppy's Corner. Harris, great to be with you today.
Hey, thanks for having me, guys.
So listen, lots have happened since we last spoke. Let's talk about all the great calls that you've made since then. Let's just start it off with the guns, your loot trade.
Oh, loot. Yeah, I got that one right. Yeah, it's been a good run for Kuppy. I'm sure I'm about to get kicked in the nuts, but Yeah, I booked all my loot after earnings. I mean, these things were all doubles. Ruger was, 40%. That's the worst one of them all. Yeah, it's just been a huge run. And when you have a huge run, you cash in. It's been a good run. I'm just basically freeing up capital for something else.
Heresies have had a great run. A lot of the stuff with the Black Lives Matter and all these other protests have been the fuel at the back of these stocks. Do you think that there is more to it than that? And do you think that they head higher from here? Like, what's your outlook?
Well, they probably go higher because if you look at the Knicks checks and you look at the back, the backlogs that some of these guys like Ruger are reporting, there's not enough guns in the supply chain for all the people who want guns. I think domestic violence is going to increase quite dramatically here in the U.S. because these things go in cycles, and we haven't really gotten into the stupid phase yet. We're just kind of in the tame, everyone's marching around breaking windows phase. And if I know anything about my fellow Americans, we'll take it to insanity phase.
Are your liberal friends still buying guns, Kuppy?
Yeah, they're buying more guns than the conservative ones. The conservative ones are already stocked up.
Yeah.
That's right. There's only so many guns you can have. Okay, so that was a great call. The other one that you had that we were chatting about was selling volatility, meaning option premium selling. Oh. Why don't we walk through kind of some of the different trades that you thought were most attractive and ask, are you still doing that?
Absolutely. I keep taking down my long book and just replacing it with a vol book. When I say vol book, I'm writing puts, usually one strike out of the money puts on stuff that I genuinely want to own. I want to make that very clear. You can go scan. There's a lot of scanners out there that tell you what has the highest implied volatility, but that's a way to get your face pounded in. Sometimes it's 200 vol for a reason. I'm looking at stuff that I really do want to own, and I want to own it at the price I'm willing to write my put at. And if I get it, I get it. And if I don't, I get my 5 to 10% a month. And some of these are actually going off at low teens still, which is kind of a great return when you think about it for 1 month of tying up capital. And I don't think you can pretty much do anything else in the markets that gives you the same sort of consistency of returns, particularly because J-Pow's got your back and we're going higher.
So Kuppy, now you're writing these like 1 month out, right? That's your target there.
Because, I'm just starting to walk myself into some September paper this week.
Right. The one I was targeting was on one of your babies there, Sting. I was actually going all the way to January, but out to January at the $10 strikes, they're paying $1.50. And so to me, like that's a pretty compelling level to buy some more Sting in at. What do you think of that idea?
I don't know. It's just like a lot more binary, If this winter isn't a good winter for Sting, they're going to have to raise capital. I still own some shares, so obviously writing puts is better than owning shares. But, if rates don't inflect pretty soon, it's not going to be a good year for them. And so, that one might be priced right. Whereas you can go look at like TK, for instance, which fully hedged, very low debt, and you can go right the 15s. You're probably getting paid $1.50 for September, which, on a $15 strike is pretty good. Here, I'm pulling it up right now.
Yeah, it's $1.15 bid.
Okay, so that's not a bad price. So it's $1.15 by $1.50. So you're gonna place it in there at probably around 130, and you're gonna make about 9% on your money, which isn't so bad for somebody that literally has zero risk. And so if you end up owning it at 1370, I'm gonna be pretty happy.
Yeah, Kuppy, let's talk about the shippers in general. What do you think about them down here? Is it finally time? Is it safe to venture into the waters again?
Well, I bought them around here in 2019 in January. They doubled. I took some off. They pulled all the way back. In February, I doubled down. They doubled again. I took some off, sold some calls against it, and they're back to the price I was buying them at 2 years ago. And since then, they've retained a lot of capital. They've delevered. They've sold some assets. They bought back a lot of shares. I've gotten some dividends along the way. I'm up a decent amount of money, not as much as I wanted to be, but they're really, really cheap. They're at half a NAV, and I think by the fall, we're going to start seeing rates start picking up again, and it's going to be pretty good. You've already seen VLGC rates pick up quite dramatically in the last 2 weeks.
I feel like
I'm still real bullish.
I feel like the shipping tourists are almost gone.
I think the shipping tourists are short now.
Maybe let's hope so. I kind of feel the same way as you, that maybe for the first time in a long while that people have finally thrown in the towel and given up.
Well, you look at the earnings coming out and you look at the forward guidance for Q3, and it's a lot better than people are expecting for most of these guys. And you look at guys like International Seaway, they reported today, they bought back 5% of the company in Q2. You look at Euronav that bought back 6% of the company so far this year. Plus, she's giving you dividends. Like, I don't know how people can be so upset with buying a bunch of steel at half of net asset value while the company is returning capital to shareholders. I don't think you're going to find much that looks like that in a zero interest rate world.
I think the other thing is with these shippers, for a while they were all going up, and I think now for the first time we really have to differentiate. What are your top, let's say, top 3 picks?
So in terms of dirty, my 2 favorites are Euronav and TK. If you want to go into what's called LPG, I'm a big fan of Dorian. And then if you want cleans, you could buy Scorpio or you could buy Hafnia.
Okay, so Kuppy, the other trade that you've absolutely nailed, and I've been hesitant to jump on this with you, and you've kind of been ribbing me the whole way up, and I deserve it, is the bits in the sky, the old Bitcoin. And I think when we spoke last, you told us to buy the Galaxy, which is the Novogratz kind of holding company. And I think you were giving me a hard time before the show started, telling me that it's tripled since we last spoke. Is it still headed higher?
I think it's gone higher. I mean, it's tripled since I spoke about it in the spring with you guys. And I think it's probably going higher. You know, that said, you know, I cut some back when it got into the mid threes. You know, one day I was looking at my position sheets and I said, well, you know, how did this thing get to be a double digit position? You know, like I put it on at 5% and here it's kicking around the teens and I'm saying, I got to cut this back a little. So I cut it back some. It has nothing to do with my view on it. It's just more that, you know, Bitcoin became too big a piece of my fund because it did so well.
Do you think that Bitcoin is just going up with the whole gold US dollar trade? Is it all one big trade, or do you think that Bitcoin can differentiate itself if we did have a US dollar rally and a gold sell-off?
I think Bitcoin's in its own little universe. I think the way you have to think of Bitcoin really is it's a Ponzi scheme. It has no fundamental value.
You said
totally
it, not
worthless.
me. You send all your hate mail to Kuppy, not me. I did not say that.
You know, I put it in my Q2 investor letter that, you know, we've invested mid-teens percentage of the fund in a Ponzi scheme, and not one of the LPs wrote back.
You've trained you've trained your clients well.
We've done well. We've had a very good year, put it that way. No, but look, I think what's happening with Bitcoin, if you like, step away from all the facts you've heard about it being, you know, the new digital currency, because that's all, you know, shit. And just think of it. You have a large stock of the total current coins. They say it's about 60% that haven't changed hands in 2 years. So, you know, that's out of the float. That's either been lost because people forgot how to get into their wallets, or, you know, that's whales that believe it's going to $1 trillion, but that stuff isn't trading. So what's left is about 40% of the total coins out there. And so you're looking at 6-7 million coins out there that make up the float. Think of it like an equity. And of that float, a good chunk of it is owned by guys that are actually acquiring more, or it's owned by various trusts. You know, I keep looking at this Grayscale Bitcoin Trust because every day they give you an update on how many more shares they've issued to buy more Bitcoins. Every day they issue between 1 million and 2 million shares, and they're buying $10 to $25 million a day of Bitcoin. And so it's kind of like squeezing the free float, and it's tightening and tightening it. And as we know, as you tighten the free float, I mean, this is Robinhood math. Eventually you get control of it, and then it starts breaking out, quote unquote. And then all the lunatic FOMO guys start chasing it into the outer space. And that's what kind of happened with Bitcoin all spring and summer. And then finally got over 10,000, and all these lunatics started chasing it higher. And you know, yesterday, Grayscale issued 5 million shares. It's one of their biggest days ever. That's a lot of money to issue. And that's a lot of Bitcoins they're buying. And they're probably going to just keep going at it and consolidating the float. And there's about 10 others of these trusts globally. Every country has one. And they're all issuing shares and buying coins. And, you know, I don't think this cycle ends because unlike, you know, you buying coins or I buying coins, you know, you have a price you buy, you have a price you sell. These trusts never sell. So it just kind of disappears forever. And I really do think it's going to be, you know, Ponzi scheme math. As long as more money goes in than out, Bitcoin goes higher. You know, I'm going to go off on a funny tangent on Bitcoin, but about 3 months ago, I was having drinks with a buddy of mine, and we were just talking about how screwed up finance is because, you know, Ponzi schemes keep going up and, you know, value stocks keep going down. And we were just saying, you know, what do you think is the most worthless asset class there is that hasn't gone yet? You know, like your Teslas and your SaaS companies, they've all gone to outer space, and you have your stock promote EV companies, but crypto really hadn't gone anywhere yet. So we start thinking, man, we should look at crypto and actually understand it. So, of course, the first thing you do when you want to learn about a Ponzi scheme is you check in with ARK. You guys see what Crazy Kathy's thinking. No, because look, I have one analyst working on my hedge fund. I don't have the resources like she does. She has 15 drama majors all trying to figure out what stock goes next. I just don't have that. I don't have people that know nothing that are buying billions of dollars of stock. So then I went to go see Grayscale because, I wanted to see. And, it just matched up perfectly because she's the third largest holder. So once you just start looking at the holder list, that's the stamp of approval that this is a qualified Ponzi scheme. Because, look, you can make fun of Crazy Kathy all you want because her entire portfolio is fraud, but she's better at selecting fraud than I am. She's better at selecting fraud than any of my friends. She's even better at it than Ross Gerber, and he runs a fraud fund also. So, once I realized that she was into this and she's been buying, it just made perfect sense that you want to go look at some of the crypto frauds. And Kevin, I've been telling you for 2-3 weeks, I thought Mara, I thought Riot, I thought these would be multi-baggers. I didn't think they'd go as much as they went, but I told you I bought a few thousand shares of each for giggles, and I don't know. I made a lot of money this week.
So for those who don't know, Harris is not scared to go and jump on momentum, obviously. And one of the things that I was most intrigued by was the recent realization that you made your start well before you were of age, and you were actually in the Street.com stock championship, right? Is that correct? I think Herb Greenberg gave you a shout out saying that I remember Kuppy when he was the 18-year-old winner of the Street.com stock market trading contest. Is this true?
That is
and
true.
Give us a story.
So the Street.com had a stock contest. I think it was 1997 or 98 or something. And I'd wanted to trade stocks. I'd wanted to get a job on Wall Street doing something in finance. And my dad didn't know anyone to call to get me a job. He got me a job at a local Merrill Lynch office or something. And I showed up and, I was 15. I'm wearing a suit, which already pissed me off because I don't wear suits very much. And, they gave me this stack of papers and they said, call all these doctors. And I was I'm not calling doctors and opening brokerage accounts. You out of your mind? And I quit the job that day, and so I couldn't get. And I wanted my dad. He has some money to give me some money to invest or play around with. My dad said, "Well, why don't you join the Street.com contest because it's fake money?" And I guess he figured he'd just get rid of me for the summer, and I'd blow up fake money in the Street.com contest. He'd never hear about it again. So anyway, I started just screwing around. They give you imaginary $1 million or whatever, and I did really well with it actually because I was buying all the tech frauds back then. I was kind of like your Robinhood trader of today. And I would just be buying the tech stuff that was going up straight up. And I think I turned $1 million into $1 billion or something during the summer, which
million to billion.
Well, they let you buy out of the money call options on tech frauds. And it was just great.
So did you end up winning it? What was the
I got
end
second
result?
place.
Oh, you
I
got second place. And you're not even of age at this point, right? You're 18
I
years
think I'm
old or
15 or 16.
15. Oh, so Herb got it wrong. You were actually even younger than you told them you were 18.
Maybe I was 18. No, I think I was younger. Actually, Herb reached out to me this week, and I had a great chat with him on the phone. He's kind of one of my heroes. Now, back then, when the Street.com first came out, it was really one of the first ways to access actual information about stocks. You had your barons and everything was in print, but this was online, and everyone was telling you these stories about all these great stocks that would go up a lot. And I didn't know anything. I was a little kid, and it all sounded great. And Herb was always the skeptical guy, and I'm a skeptical guy. So it's kind of bonded with him through the internet, being I like this guy. I like how he thinks because he calls bullshit when he sees bullshit. And everyone else just says buy bullshit. And so I had always been a fan of his. So it was kind of cool. He reached out to me. We chatted on the phone. Super smart guy. Big fan.
Well, that's awesome. That's a terrific story. So how did you go from there? Like, what was the next step? So you win the street.com. I think you went to university, and that your love of guns came from there. Like, I was recently reading one of your tweets where you said that you went to Tulane and you all had to buy guns.
I didn't buy a gun. I was too much of a drunkard. Thank God. I would have shot my foot off. But no, I went to Tulane, and New Orleans back then was a very dangerous city. It's still a dangerous city, but I think it was unusually dangerous back then. And, there was just a lot of murders on campus, and people started carrying guns around. And, we had a bunch of break-ins in our fraternity house, and our fraternity brothers then shot back. And as you can imagine, if you're inside of a house and multiple fraternity brothers are shooting from opposite directions at a criminal, I'm amazed no one got shot, like the criminal or the brothers. But
sorry, go ahead. Finish your thought.
I remember I was asleep one day. This is like my junior year, and I'm on fraternity row, and I'm sleeping. I hear this thud, and I look up, and there's this bullet hole like 6 inches above my head, and I'm thinking, what the fuck? And I go to look out the window because it's, I'm just like, where'd this bullet come from? And I see the fraternity house next door to us, and they had some cans lined up like on my windowsill, and they were literally like at 50 paces shooting the cans drunk.
Oh God. So you graduate from there. What's your next step? Like, how do you go from being, a drunk fraternity brother to, I guess, the CEO of a Mongolian mining company?
It's not mining. It's the only thing we haven't done yet.
Oh, okay.
That's the only thing we haven't screwed up yet. No. So, if you want to go back to my background, so I was trying to get some money together to go trade, but I didn't have any money. And I finally decided I was just going to go sort it out myself because I'm very much a sort it out myself sort of guy. So I started cleaning pools one summer, and I made about $5,000-6,000 cleaning pools. Plus I had some money I'd saved up. So I had like $7,000-8,000 in my account, and I just opened a brokerage account. And I had no idea what the hell I was doing. This is like 1998 or something. And I pretty much lost all of it because, I was reading this stuff about day trading, and I figured I'd compound my money, double my money every week. And it just doesn't work that way. And, this is back when, this is back when bid-ask spreads were wider, and, the commissions were $10 each time you put a trade in, but I was trading 100 shares. So, I was losing 30 cents, let's call it, on the way in and on the way out. And, I just got chewed up. I didn't know what the hell I was doing. And
those commissions back then were crazy. Like, I remember I did something similar, and I threw like $5,000 into a day trading account, and at the end of the month, I spent $2,000 on commissions. How do you beat that nut, right? Like, it's anyway. Go on.
Yeah, I just got chopped to pieces. I didn't know what I was doing, and I was down to like $2,000-3,000. And in 2000, I just kept reading and learning and just absorbing information. And then in 2000, once the bubble broke, I came to realize that you'd have these unlocks. So you'd have these VC guys who literally had, nickels, dimes, cost basis, and these stocks are trading at 200, and there'd be no float. There'd be 100 million shares outstanding, but 3 million in the float because that was the IPO. And then, 100 million shares hit the market, and these VC guys knew that these things were worthless, and they literally didn't care what price they got. They were just going to blast it to bits. And so after I saw a few of these, I realized that basically you could get short. You could get short 2-3 days before the unlock. They might squeeze it, but as long as you hold with it, you're going to make 50 to 75% in the next month. And, some of these had options, and I was playing these super big. Like I was buying, 10% of my account in out of the money puts, or I was doing like 30% of my account in one name. But I basically turned $3,000, and by the end of 2000, it was over $100,000. It was actually a good chunk over $100,000. And so, that gave me the staying power to go figure this all out. And, once I found that one pattern that worked, I started putting a lot more of my energy into pattern recognition. And I found other patterns that seemed to be, very high probability in terms of like event-driven sort of things. Unlocks 20 years later are still very high return strategies. But I made a list of about 10, 20 of these other strategies, and I've been playing them ever since. And they go in cycles. Sometimes, they're really good. Sometimes they're not so good. You can't put huge amounts of capital behind some of them. Some of them you can. But there's a lot of ways you can make money if you just look at fund flows. The odd thing right now, fast forward 20 years, is that as a lot of the capital goes into ETFs and the active management community has kind of this like extinction event, you have less and less guys that are able to take the other side of these fund flows. So when you have a corporate action that leads to a fund flow, you just have no one there, and this ETF just keeps barfing stock everywhere. There's like no one who front ran it and shorted it. There's no one who's going to buy the dip. It just kind of keeps going on, and it overwhelms every prop desk. And so I've actually found these things are working a lot better than they used to. I mean, there was like a 15-year period where the results were kind of mediocre, and now event-driven and put writing is a lot of what I'm doing, quite honestly, just because it's paying so well.
Yeah, I completely agree. I think all these people complaining about all the indexing are full of it. They should just be like, if it really is that much indexing and the market's so inefficient, go take advantage of the inefficiencies. Don't complain about it.
Yeah, absolutely. I mean, there's so much weird inefficiency. You just have to read the fund doc and figure out what the stupid strategy is. I mean, a buddy showed me this Contour Brands, okay, KTB. It got kicked out of some dividend index. I have no idea how, but this stupid stock got to be 20% of a dividend ETF. Like you could see the print because it's so much bigger than any other trade in the history of the stock. The last day of May, I mean, they sold this thing down mercilessly in order to price that thing. And then as soon as it priced, you could get long because the selling was done. It's just one of these things that event-driven things that just keeps happening. You just have to be alert for them.
What was your other favorite strategy or two that you or pattern that you came across that you wouldn't mind sharing?
So I've been a big believer in secondaries that are well telegraphed. You have these things where everyone knows there's a secondary coming. Whether it's a biotech, oh, the drug worked, great, the stock goes up 50%, and then for a week the thing trails off as they price the secondary that you need to get through phase 3 or whatever. Like once that selling's done and these guys are cashed up for the next year, the short sellers have to cover. Anyone who didn't get a full allocation has to go buy. It just trades up out of the secondary. That's the sort of secondary you want to buy. We were talking about this utility, PCG, that came out of bankruptcy, okay? Everyone knew for the last year and a half that they would do a giant secondary, okay? Everyone knew that it was going to be a sloppy secondary because of how it was structured with a backstop and everything else. And so no one wanted to own it until after the secondary. The secondary priced, implied volatility went sky high. I wrote a ton of puts. I bought some common, sold calls against the common just because the vol was high. But it was just free money because you just knew that once the thing priced and it came out of bankruptcy, there'd be this wave of ETF money that had to buy it. And, it's going to be part of every stupid ETF, the low vol ETF, the utility ETF, the S&P, whatever. All these guys are going to buy it before year end. And you just know that there's a backstop to it, and you could write as many puts as you want, or you could buy some common, whatever you want to do. But it's just these secondaries that people know, you can just wait for it and then buy the secondary.
Yeah, I agree.
I just love that strategy.
I also find that anytime you get a secondary that trades up, it just means that guys have gotten cut back way, way too much, and that there's going to probably be guys that are short, and there's going to be people that are be disappointed with their fills and are going to go chase it in the open market.
Yeah, absolutely.
It's to me, that's the best sign is a secondary that trades up right away. So let's talk a little bit about the opportunities that we see right now. One of the things that as we write or tape this is that gold has been screaming for the last months or stuff. But I take it that one of our favorite guys that we would love to highlight, let's just say, Kuppy, you and I. He came out with a line the other day that I just knew was had trouble written all over it. Why don't you tell us about what he said and what it means?
Let me pull up this quote because I don't want to get it wrong. So here, Ross Gerber, gold, the easiest trade in a long time. And then he gave you $ GLD. And, I guess you responded to that Rutro. And I responded, danger, danger, time to short some GDX ? I don't short, but I should have. But I also said anyone who says they don't ring a bell at the top is just bitter that Gerber blocked them. Because literally to the tick, that was a high tick for this move. Look, gold's going much, much higher.
Oh, yeah.
But gold could drop another $100 from here and still be in an uptrend.
Yeah. Someone did say, though, that rightfully pointed out that although he might be a short-term, interim sentiment top, that he is actually pretty good at picking the frauds that continue to let's just say, confound the skeptics.
Yes. When you have a Gerber Crazy Kathy cross, you should buy it every time.
Listen,
that's my indicator. That's my technical indicator.
The Gerber Crazy Kathy cross. You mentioned there that you don't short, and one of the things that I do know is after chatting with you is how little you do short, and especially it's been wise beyond belief in this market not to be short. I thought maybe you could talk about the experiences that you've seen around you recently with some of the violence of this move and why you are so vehement that you shouldn't be short and you should, even little positions might end up hurting you.
Well, I just see my friends get obliterated. I guess there's a reason that a lot of money is coming out of active management. All these guys were long. The market crapped out on COVID. They all sold the lows and they got short and they got whipsawed the other direction. And it's just crazy how much money some of my friends have lost. But it's also crazy some of the just crazy moves that we've seen. So one of my closest friends, he was short some Kodak. Okay, Kodak was going to zero. It might still go to zero. And it was like a $2 stock, and he had a basket of legacy over-leveraged legacy tech. I don't even know what he was doing. I don't think he even knew. He just threw together a basket of like 20 names just as like a beta hedge on whatever else he was doing. And so the 100 bips position, and he wakes up and Kodak has a deal with the U.S. government. It's at $9. And he's just like, well, why would anyone want to get into pharmaceutical supply chain? That stuff got offshored because there's no money in it. Like, I don't care if they get free money to build this. There's no return on capital still. So he shorted some more at 8. And, the next day Trump had a press conference and, pumped it. The stock went to 60. So 100 bips at $2 was, 30 times up. And, it went over a third against his portfolio. Probably with his ads, it was down 50%. Like, he literally lost half his fund on some name he had zero conviction in any way. He probably didn't even know he had it. It was probably one of his analysts that dumped it in the book. It just shows you how stupid this is and how crazy it is, and how when something gets in the news, every guy on Robinhood goes out there and slings 200 shares and they overrun it. Like, Kodak had 22 consecutive halts on that day that it went parabolic. He couldn't cover the position if he wanted to. I guess one thing with market structure I should point out, they added these circuit breakers, okay? So on the way down, circuit breakers, sure, they kind of make sense. And, you don't want to have like some rogue algo crash the market. But what happens with circuit breakers is because, you have a pairing off and, it basically halts, then it gaps, you have a pairing off and it halts again within about a second or two. And it just goes up limit, up limit, up limit. And because the up limits, it forces people to use market orders to get filled, especially if you're short, because it's terrifying. And so you're going to be out there market order buying, and all it does is it just accentuates the move, I think. It's the reason you had 22 consecutive up gaps and then like 4 consecutive down gaps. And it's just kind of silly. Thankfully, the stock dropped back to like 25. My buddy brought it in, and he walked away kind of a burned hands and nothing too bad. He'll bounce back. But it's just crazy. To be down half your fund on some stupid thing. And that's why I just keep telling people stop shorting. This world has gone too crazy, and Robinhood's made it nuttier. And, it used to be you had market makers, you had dealer desks, you had people who take the other side of these moves. And now you don't.
Right. And not only that, with the amount of printing, and I know that's kind of, I don't know if printing is the right word, but the amount of stimulus in the system, it's made it so that some of these moves are just explosive. As you rightfully point out, if the Robinhooders get a hold of it, who knows where it could go?
Yeah, it's just too hard. Look, if the Robinhooders, there haven't been any bear raids yet, which I think is odd. I'm sure it's coming. But if they knock some stock down from $10 to $2, well, I'm just going to triple my position. I don't care. I'll just sit with it. Like, I don't run a levered book, so I don't really care. But, you can get just run over it if you're short. And I just tell everyone to stop shorting. It's
actually amazing that they're not getting into any more trouble with the SEC for these bull raids that they do. Like, that one section of Reddit is just, what is it, Wall Street Bets? Like, it's how is that different from the 1920s when they used to have consortiums that would move stock around?
I don't know. It makes no sense to me, but I think the SEC is just giving up on their duty to regulate anything.
That's funny. So listen, what do you think's going to happen to our good buddy Ross Gerber's gold position? What are you seeing? Like, do you think that it's just a week or two kind of correction that cleanse the the correction that cleanses, or is it something more serious?
No, it's going to probably be more than a few weeks. I mean, you look at a gold chart, it's effectively gone from 1,200 to 2,100 in 18 months. That's a really big move. And I mean, there haven't been that many pullbacks. It's probably going to have a pretty violent pullback. And then it probably just keeps going again. I have a core gold position. I haven't sold it. I don't really care. I want to be long gold. But I expect it to be a pretty violent pullback. There's a lot of FinTwit bros talking about how much gold they own and how the world's ending. And that's usually not a good sign for gold.
I always like to remind people that the biggest and sharpest corrections always occur in bull markets. Yeah. Bear market is actually that relentless drip, and that's a completely different thing. And actually, in bear markets, we often get the opposite. We get huge ripping rallies that are 10, 20% in a day, and then it goes back to the drip. So don't ever forget that the bull markets have these violent, quick corrections.
The one thing I'd add to that, though, like let's talk silver for a moment. And like, if you,
Silver's the nuttiest.
It's the nuttiest. But if you go back to the bull market from 2000 to 2011, when it went through these long periods where it just trades sideways and it's in purgatory doing shit all, and you're just watching paint dry. And even like in 2004, the thing goes and doubles from like $4 to $8 in a parabolic rise, and then gets slammed 30%. Then you move forward 2 years, 2006, the thing goes from like $6 to $14, just this parabolic rise, gets slammed another 30% on the downside. And then it does it again in 2008, goes basically like from 11 to 22, hits a top, and then gets caught in the 2008 downdraft and wipes out 50%. And each time it recovered and has another bull leg coming on the other side until it hit its 2011 high. But each time we saw these doubling of silver, it just goes parabolic, and then they slam it to the downside, just wash everyone out, and then it begins the next bull phase all over again. And you have to think, like, why wouldn't that happen again at some point?
Oh, absolutely. I'm pretty confident that silver is going to have a teens handle before the year's out.
Really? All right.
I like it. I like the
boldness. Call. It's not out of line.
You know what?
I don't think you're a professional trader until you've, had silver just manhandle you.
No, it's until you've been manhandled by silver.
That's how you grow your pubes. Sorry, that's off color. But gold is, just like, gold's a funny product too, because on the way up, it's like 100 bips of intraday range. It's like this nice, sweet girl, and then you put 2 tequilas in her, and she's gone nuts. And then like silver is her just batshit crazy sister.
Who's always more fun. Okay, speaking about, it's unfortunate that Patrick doesn't feel differently, because it would be nice if we could maybe pick Patrick off on another bet. Because Patrick, remind me if I'm wrong, but could you tell us what the quote is on our little European currency friend?
The Euro USD, it did hit 119 on the upside. Yeah.
Yeah. So I actually feel a little bad about that. For people who don't know,
Kuppy,
on. Kuppy went and picked off
I'm
my
a
partner.
big boy. I'm a big boy. I can handle my own bets. Don't give me this
I
shit.
know, but I shouldn't have jumped all over it when you did a bad price. I shouldn't have hit you with another size.
Oh, come on.
So anyways, the long and short of it is,
what's a steak amongst friends?
Well, it's going to be an expensive one in Miami, right, Kuppy?
Yeah, come to Miami, guys. I haven't met you yet.
Yeah,
I can't go to Canada. You got a quarantine still up there.
That's right. You're not allowed. We don't allow.
Not allowed. No Cuppies.
That's funny.
Yeah.
But yeah, it's. I thought I was looking pretty good until the COVID hit, and then the U.S. government and Fed just proved that they can debauch their currency worse than the Europeans. It's like it's an amazing feat.
Well,
it's
no milkshake for them.
Yeah. All I can say is that Kuppy goochered it twice. By every time it got close, he opened his mouth and started talking about it. So this third time when it got up there, I sent him warning notes. I said, no talking about euro. No talking about euro. So he kept his mouth shut and it went through. Thank God. So now we're got some stakes. So we'll have to figure out the next bet. We'll figure out something good, but we should actually take delivery of this bet, and it's going to be difficult with the COVID. And
you guys should come down here in the winter when it gets cold.
Yeah, that's true.
Done.
That's true.
I'll be there.
I don't know. Are we allowed back after we go down there, though, Patrick?
I don't mind staying a while.
That's right. Patrick's actually looking at setting up the Barbados office of Big Picture Trading, by the way.
The big reveal. Thank you. Let's just keeping it on the down low here.
Was that supposed?
No, it's all good. It's good.
No, for those who don't know, the Barbados is willing to take. I don't know if they're willing to take Americans. I think it's Canadians only. If we show up with a COVID test that proves that we're negative, we can go live there for, I guess, and work for the whole year.
Yeah, a work visa for a year, basically.
Well, and listen,
free.
No Canadian's going to go now because we only have 2 months of summer, so we're not leaving now. But come November, December, January, I think that they might actually find a lot of Canadians take them up on their offer.
Yeah,
It should be interesting.
I know a few.
Do you honestly that are? Oh, you actually. Do you want to cut this, Patrick?
No. It's all good. It's all good.
I've never been to Barbados. Have you?
No.
How about you, Kuppy?
No. I went as a little kid once. I haven't been there in 35 years.
Oh, I don't think they're going to let you now, though. It's like Bahamas. You're not allowed there either.
We're not allowed a lot of places. I'm not even allowed in New York right now.
Yeah, that's true. Well, you know what, Kuppy? Actually, I went and we're driving our oldest to a university out in the Maritimes, which is the east coast of Canada, and we had to go through. There's something called the Maritime Bubble, and going from Quebec to New Brunswick, we literally got pulled over. It was like like a Cold War, like I was smuggling people out of East Berlin. and not only that, we've been getting calls every day to make sure we're on our property and not leaving.
Really?
They're taking it seriously. Hey, listen, do you blame them? They basically have no cases here, and the last thing they want is a stupid Torontonian bringing it over and ruining it for them. They already hate us. That's what my wife says. We're already kind of in the bad books. The last thing we want to do is be the family that brought COVID to the place where they have done. Oh, well. Anyways, so Kuppy, you got any good last kind of stories or calls for us before we leave you for another month? What do you got planned, actually? You told me that you're finding trading is a little more difficult and you're going to take some time off?
Yeah, I mean, August is always kind of shit for trading, quite honestly. And I got a really big vol book, and it's just going to bleed itself out. So there's nothing really to do there. And I've taken my exposure way down just because I had this huge run in crypto, and I took a bunch of that off and took a bunch of my inflation plays off. I took my loot off. I'm actually lowest exposure I've had all year. So I'm just going to kind of wait it out. I think I'm going to go with the wife and go driving around in America and go explore because there's nothing else to do.
The states that'll still take you guys.
I might just stay in Florida, but yeah. I think we're going to go back to the Panhandle, actually. I'm a big fan of that place. So
yeah.
That's probably the direction we're headed.
Well, that's awesome. That's terrific. It actually, for those who don't realize, August is actually one of the more sketchy months when you look at a seasonal chart. So I don't think that there's anything wrong. If you think back, what we've had, long-term capital crisis, it was in August. The flash crash was in August. There's a whole bunch of August is traditionally.
Don't get me excited now.
Well, I know this. This is like bear porn for Patrick.
Yeah, exactly, bear porn.
As I reminded all my readers, do not Google bear porn. It's completely different. It means something completely different outside the financial community.
But I guess when you think about what's happening right now, the Fed's on QT, which isn't usually good for asset markets. The economy doesn't really exist right now. Depending on which state you're in, it's either getting worse or better. It's very different by states. And, you know, the federal government's talking about doing a big load of fiscal. They're not sure if it's 1 trillion or 3 trillion. I mean, what's 2 trillion? Like, they just kind of make it up at this point. But if they really go and do, you know, 2 trillion, let's call it, and the Fed's on QT, that's going to take a lot of liquidity out of the market in terms of, you know, them having to issue treasuries. So it might not be what they were hoping for, actually. If the Fed isn't there to absorb that sort of issuance, that's a lot of treasuries.
Hey, sounds like we got the makings of a bond bear there, Patrick.
Whoa. Oh.
In any case, I'm gonna see what happens and do it without much exposure. I've had a pretty massive year, and you know, when you get to August and you're up as much as we are, it's more a question of just not doing anything too stupid.
Yeah.
But I guess one final thought. I got this asshole in my gym, and I think he's had the biggest year you've ever seen. He knows nothing about finance. I don't even know if he knows what he's doing in the slightest bit, but he's basically just bought weekly call options on Apple. And I think he's like 20 baggered his account this year. And I'm sure he's going to be at the gym today. And for the first time in a while, you know, he's not going to be bragging about how much money he made in weekly apples. It's a Friday and looks like he's going out worthless. I feel good about this world.
Don't want the asshole in the gym doing better than you. That's for sure. So, Kuppy, listen, thanks a lot for being with us. We look forward to getting another update next month. In the meantime, have a great time in the Panhandle. Enjoy yourself. I hope you get nice weather, and I hope you get, for your vol book, a nice, calm, easygoing August in the markets.
10 days
or
left.
you get to own everything that you wanted to own.
That's right. Take care, man. Thanks for joining us.
All right, take care, Kuppy.
Great chat.
Cheers, guy.
Okay, Patrick. I don't even know what to say.
Well, that's it for the show. Thanks for joining us.
That's it. I think we should just use this.
There you go. That's it.
Seriously.
Just follow us, subscribe to our channel. That's it. We have nothing else to say.
Yeah. So listen, everyone, thank you very much for joining us. I was just kidding. We obviously really appreciate you spending the time with us. For those who want to make sure that they stay abreast of all things Market Huddle, make sure you follow us at the Market Huddle on Twitter. Patrick, where can they find you?
You can follow me on Twitter at Patrick Ceresna, and you can go to my website, bigpicturetrading.com. Kev, where can they follow you?
I'm at Kevin Muir, KevinMuir, and you can check out my newsletter at themacrotourist.substack.com. You think I'd be better at that after practicing for a while?
You would think.
You would think. This is what happens when you're on vacation, Patrick. Things fall off, and it's very, very poorly executed.
So just as a note to everyone, we'll just be back to our normal format next week. So this is our last part of our little summer special. We forgot to talk beers. Yeah. Oh my God, Lena, hop on here. Like, I was drinking. Did you? How about you guys?
I wasn't.
Yeah.
I wasn't, but I'm about to.
Oh, you're about to start.
I had this one beer.
I cracked open this Conductor Craft Ale. I mean, we've talked about. I've had this one before. It's a go-to from Junction Craft Brewery. I love it. It's a nice, smooth craft ale. I love it. Anyway, that's what I've been drinking. I guess we should have mentioned it earlier in the show, but.
I'm actually not even drinking a beer. I'm actually drinking a cider.
Okay. Well, listen. I mean, it's summer, so you can drink whatever you want in the summer. We're gonna get to our sponsored beers next week, right?
That's right.
Yeah. It's gonna get serious. The show's gonna get tight next week.
We're gonna have to up our game. Anyway, so
Patrick, what were you up to last weekend?
Okay, I went up to the Ottawa River for a whitewater rafting and what is it? Whitewater. What is it called? Boarding. Like, what do you do? River boarding. Where basically you're like on a. That's it. No, river boarding, where it's like literally. It's a.
You did it. You don't even know what it's called.
No, it's riverboarding. It's like a surfboard, but with handles. You don't stand on it, and you're actually going down the rapids on a board.
That sounds
by yourself.
No idea.
And you, when you get to those little, I don't know what they call them, the little things with waves do that thing. You can sit in there and surf the wave for like 30, 40 seconds. Just like you sit right in the thing and just ride it like on a surfboard.
I think it's called a standing wave, actually.
Is it a standing wave? Anyway,
Yeah.
And so, but the point is, it was awesome. It was a great time. But man, did we get dumped? There was when we were on the rafting thing. We hit on the Ottawa River. There's this one rapid that is called the Coliseum, and it has a notorious reputation of just wrecking rafters. And and so, because there's like this one rapid that if you can't clear it, they call it the hockey stick, where it's like this one long rapid, and if you can't clear it on the top, then you ride down into this one rapid called the Pac-Man, and it just eats you, and it just like completely just destroys everyone, and so like I think 3 out of the 7 boats cleared the hockey stick rapid. And everyone else just ate it, including us. It was epic. We got some footage of it.
That's right.
Right. So we're going to share that. For those who want to watch it, you got to go watch it. And Patrick, which one are you? So everyone knows.
Oh, I'm not going to. The red shorts.
The red shorts. What I like best is when I am asking who everybody is, I was expecting this to be all Patrick and his friends/family. And he tells me, no, the people who got dunked were some random Russian couple.
Well, we all got dumped. But it was Buddy. Jon Snow was on the boat.
Yeah.
And so was Dougie Boy. And you met them all at different Market Huddle
events,
drink events. Yeah, absolutely.
Yeah.
And so they were both on the front of the boat there, and we all got dumped in the end. It was a shit show, buddy. Like
Kevin called it.
Like
it was
Patrick,
a disaster. That's what he said earlier.
It was your boat, of course. Like Jon Snow should have known a lot better than to get in the boat with you. I would have been like any boat but yours. Put me with those grandmas over there. I'll take them over Patrick.
Fucker.
It's kind of hard to say no to Patrick.
You were probably drinking too.
No.
Like you're drinking ahead of time.
No.
Oh, this is serious. You took this seriously. Oh, you okay?
They have a policy. You can drink the night before and get hammered that night, but you're not supposed to be drinking during the rafting trip. Like they need you sober at that because there is like risk of drowning and stuff. They take that part seriously. So we were a little bit hungover, but we were in pretty good form. No, we
nice.
Until you got.
It looks like a lot of fun. I'd never heard about this. What did you call it? River rafting or
riverboarding.
Riverboarding.
Yeah, check it out. Google it. Right. Or
all I can think about is like it was probably invented by like some Canadians from Algonquin.
Yeah.
That were doing like the riverboat loggers waltz. There's some very famous kind of Canadiana. There's a song. And for those who grew up in Canada, you know this song. Maybe you could find it and put it on include it on the.
I'm giving you more work.
Goes out. Yeah, but we got to do this. But all I could think about was it was kind of like that, and all I could picture was you guys tying up a whole bunch of logs together and turning it into a raft. And I just kind of thought, oh God, I could just see you guys doing that. Going, I've seen this on the riverboat, the loggers waltz or whatever. Let's tie these all together and go run the rapid.
I'm just glad it wasn't a video
good.
of him hunting squirrels. So.
Oh my God! Are you guys ever gonna let this down? Like, no.
No, the squirrels are pretty awesome.
Yeah, that's.
Oh my God!
Yeah, that's one for the books.
Yeah. They weren't that tasty, actually.
Well,
I'm not thinking like we should go and do it again. Like, no. That may be the one time I ever do that, and ever.
Never
but
say
you
never.
know, Patrick, here in I'm in Nova Scotia, as I've told you, and they have, instead of rabbits, they have hares.
They're much bigger.
And these things are,
they're
gigantic.
Huge. Yeah, these things actually look pretty tasty, I must say. Like, I would be if Patrick was here with his gun, maybe I would let him try. Although they're kind of cute. My family would never let me live it down. Although I did see, unfortunately, we are confined to our house for these 2 weeks as we have to stay in the one spot. But I did notice that puffins are also in Atlantic, Canada, which I had no idea
is that
about.
Right?
Yeah, and so I asked
and you
my
are
kids
prepared
so you have no short
to go eat them.
Yes.
As I've told For those who don't know, I was in Iceland with my best friend, and we were there, and we were like, what are we going to eat? And you got to eat something that's local. And I saw that puffin was on the menu, and I was like, oh, well, when in Rome. So I ate a puffin. And I've never lived it down with my family. They think I'm this horrible guy that eats Disney characters.
What is it comparable to?
It's kind of like a bad duck.
Bad
duck.
Yeah, it's just like, it's not good. Listen, I wouldn't do it again.
But you're glad you did.
I'm glad I did. I think that we here in Canada, we're smart enough not to eat them. Like, why would we want to eat this stupid puffin when there's all these good tasting ducks? Yeah. Yeah, sure, there's a lot of them. They're easy to kill because they all wander by the side of the ocean. But really, I'd rather spend some time and go for a good tasting duck.
There you go.
Okay, well, on that note, everyone have a great week. Thanks for listening, and we'll catch everyone next week.
That's right.
Have a good weekend, everyone. We'll back to normal next week. All right, cheers, guys.
Bye-bye.